Hello everyone and welcome to Financial Accounting. In this video, we will continue analyzing business transactions using the Integrated Financial Statements framework. Today, we will look at borrowing. As we already learned, an integrated financial statement framework demonstrates the impact of transactions on the balance sheet, income statement, and the statement of cash flows, and the corresponding relationship among these financial statements. If you would like to learn more about the basics of the Integrated Financial Statement Framework and look at other transactions, I'm posting the link to the playlist here and in the description below. I will show you more transactions in separate videos. Make sure to subscribe so you don't miss new videos. Remember that accounting equation is the basis for the framework. Assets equal liabilities plus stockholders' equity. In part 1, we looked at transaction where Emily invested $100,000 in her business. This transaction was recorded as an increase in cash, which is an asset account, and an increase to capital stock, which is a stockholders' equity account. I am posting the link to the part 1 video here and in the description below. Now, let's look at the second transaction. In the second transaction, Emily borrowed $40,000 by issuing a note payable. A note payable is a written promissory note. Under this agreement, a borrower obtains a specific amount of money from a lender and promises to pay it back with interest over a predetermined time period. Let's see how the second transaction affects the accounting equation. By borrowing cash, cash increases by $40,000 and liability also increases by $40,000. Cash flows from financing activities include cash flows related to borrowing and stockholders' equity. Therefore, under the statement of cash flows column, this transaction increases cash flows from financing activity by $40,000. The total cash inflow from financing activities is $140,000, which is the sum of $100,000 from stockholders' investment and $40,000 from borrowing. This transaction doesn't have any effect on the income statement. Under the balance sheet column, cash, an asset account, and notes payable, a liability account, will increase by $40,000. This increases the cash balance to $140,000 and notes payable to $40,000. The capital stock balance remains at $100,000. Now, let's make sure the accounting equation for each transaction and totals are in balance, and that the ending cash on the statement of cash flows is equal to the ending cash on the balance sheet. In the first transaction, $100,000 in assets equal $100,000 in stockholders' equity. The accounting equation balances. In the second transaction, $40,000 in assets equals $40,000 in liabilities. The accounting equation balances. Totals for two transactions, $140,000 in assets equals $40,000 in liabilities, plus $100,000 in stockholders' equity. In the next video, we will look at the revenue transaction. If you have any questions, leave them in the comments below. I hope you found this video helpful. If you did, please subscribe, hit that like button and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.